So markets were certainly surprised, and we saw a very big initial sell-off across pretty much all equity markets. And indeed, yields on bond markets initially fell with the concern that maybe a Trump presidency will introduce new levels of uncertainty. Some people were even saying the US economy will go into recession next year. Interestingly, as the day has worn on, there's been quite a reversal in those trends. And what we're now seeing is what I think is the correct way for markets to respond. Equity markets actually being quite relaxed about it, if anything, going up. And bond markets actually selling off. In other words, yields going up, which I think is the correct way to interpret what Trump is likely to do. So it's introduced new levels of uncertainty, but this is absolutely not a globally systemic event. It shouldn't worry investors to the extent that there is no issue in terms of global liquidity being damaged, global economies in the short term certainly not being damaged. So it's sort of business as usual, but I think there are some pretty serious implications further down the track. We can't be sure about his policy, of course, because much of his campaign rhetoric you treat with a great deal of caution. Some of it was literally campaign rhetoric, some he might try to implement in terms of policy. The fact that the Republicans now control both the Senate and the House and the presidency, that gives him a much better chance of implementing some of these policies. But I suspect he's going to be a lot more measured in his approach to this once he assumes the role of presidency. And indeed, we saw a more measured Trump today in his acceptance speech, much more conciliatory and measured. So I think we must expect more of that as he takes on this role. But despite these uncertainties over what policy will be, I think we can see some of the things he's clearly got to try and push through. One is definitely more fiscal spending. At the very least, he's got to do that in terms of trying to help out the lower echelons of society who have been perhaps most impacted by globalization. He needs to see some benefits flowing through to them, and arguably more fiscal spending will help there. So definitely that. I think we might well see some loosening of controls and regulations in certain sectors. He's alluded to that in areas such as healthcare, rolling back Obamacare and those types of things in the finance sector. So some sectors will, I think, benefit from this directly. And I think there's likely to be tax reforms and quite possibly tax cuts. Some of that I think will get through. And that, generally speaking, on balance, I think is going to be good for growth. So we see no reason to reduce our growth expectations for the US economy in coming years. The big issue that he also spoke about, of course, in the campaign was protectionism and reforming trade agreements around the world. Now, the extent to which he'll be able to do that is much less clear than the fiscal spending side. And I suspect that protectionism is still some way down the track. Possibly some renegotiation of the North American Free Trade Agreement, certainly not continuing with the Trans-Pacific Partnership, those types of things. So longer term, I think there is potentially some damage to global growth from more protectionism starting in the US. And I think that the US will ride that out pretty well. It's typically what we've seen historically when these types of things happen is economies and markets outside the US are more negatively impacted than the US itself. And emerging markets in particular would be vulnerable if trade barriers and tariffs are increased. So that, I think, is a medium to longer term negative for the global economy. But the implications of all of this, I think, are not particularly damaging for equity markets. Growth looks okay. Much more worrisome for bond markets, where I think that more fiscal spending and higher debt levels must be a negative for government bonds, in the US in particular, and must be somewhat inflationary. So we've got to watch out for inflation picking up more than we would have anticipated otherwise, and I think we must expect bond yields to continue to rise. I think this great 35-year great bond bull market is now over. I think what this does is raises levels of uncertainty and it raises political risks. And I think politics will be very, very firmly on the agenda through 2017. And if I look across what is happening in Europe with the elections to come in France and Germany in particular next year, we certainly would hope that the Europeans have taken very careful note of the shift towards populism and away from globalization that arguably this election in the US represents, and indeed to some degree the Brexit vote in the UK earlier in the year. So I think politics will be centre stage through the whole of next year, uncertainty levels quite high. This comes at a time when most asset classes are trading at pretty high valuations. So it introduces for us a degree of caution, and we are looking to invest in assets which give us a bit more protection. And we have been in the process of doing that before the election and continue with that process. To us, equities look okay still in terms of valuations, and I don't think are particularly damaged by the Trump election. Bond markets are much more troublesome, and we will certainly be cautious about bond markets as we have been for quite some time. We'll be watching yields very carefully, of course. If they spike up to extremely high levels in the next few months, that could be an opportunity, but they're certainly not at those sorts of levels yet. But a key message in all of this is to maintain very broad diversification across portfolios at a time when arguably uncertainty levels are higher than they've been since the global financial crisis 8 years ago.